Interest rates play a vital role in the economy and have a significant influence on our daily lives. Today, we will be delving into a subject that has been grabbing attention: interest rates. Have you ever considered why it makes headlines when central banks choose to increase interest rates? We're here to simplify it for you, so stay tuned. Let's begin with the fundamentals. When you take out a loan for a car, house, or personal expenses, the lender anticipates repayment of the borrowed amount plus interest. This interest represents the expense of taking out a loan and is typically stated as a percentage of the total borrowed amount. Several factors, such as your credit score and the type of loan, can cause fluctuations in the interest rate. Naturally, as a borrower, you would prefer the interest rate to be as low as possible, since a reduced rate equates to paying less money over time. An instance of this would be borrowing $1,000 at a 5% interest rate, resulting in a repayment amount of $1,050. Yet, if the percentage was 10%, your debt would amount to $1,100, illustrating a notable contrast. On the other hand, a higher interest rate benefits you when saving money in a bank account. In this situation, the interest rate indicates the income you earn for depositing your money in the bank. Consider it as a form of compensation for permitting the bank to utilize your money. For example, by placing $1,000 into a savings account that yields a 2% interest rate, you could make $20 in 1 year. Yet, with a 5% rate, your earnings would amount to $50. This is the reason why numerous individuals seek out savings accounts with elevated interest rates. It facilitates quicker growth of their funds in the long run. Understanding the mechanics of interest rates is essential for both borrowing money and saving it, as it can have a substantial effect on your overall financial well-being and potential savings down the line. But here's where it gets interesting. There's no single interest rate in the economy. Different banks set their own rates based on several factors, including the rate established by the central bank. The central bank acts like a bank for other banks, providing them with a place to deposit their reserves. When commercial banks deposit money with the central bank, they earn interest on those reserves. This system helps maintain stability and liquidity in the financial sector. When central banks choose to increase interest rates, it impacts individuals and businesses on a broad scale. One main purpose for raising rates is to manage inflation, which is the speed at which prices for goods and services go up. Central banks like the Federal Reserve, the Bank of England, and the European Central Bank normally target an inflation rate of approximately 2%. By changing interest rates, they have the ability to impact the expenses associated with borrowing for individuals and companies, consequently impacting choices related to spending and investing. When interest rates increase, lending costs rise, potentially hindering economic expansion and aiding in controlling inflation. Having a grasp on how interest rates and inflation are related can assist us in making knowledgeable financial decisions in our day-to-day activities. So what happens when interest rates go up? It increases the cost of borrowing. When interest rates increase, they can have a substantial effect on both individuals and companies. For people, an increase in interest rates results in loans costing more. If you have a mortgage with a fluctuating interest rate, a rise in the central bank's rates will result in higher monthly payments. This results in a decrease in the amount of money available for everyday expenses, such as groceries, entertainment, or saving for a trip. When individuals start spending less money, restaurants and stores may experience a decline in their customer base, causing a downturn in the economy. On the business front, increasing interest rates also present difficulties. Businesses looking to borrow funds for growth or new ventures will encounter higher costs in obtaining the financing. This could result in a hiring slowdown, as companies might postpone hiring new staff until they have greater financial certainty. Moreover, businesses might be reluctant to increase their prices due to reduced consumer spending, potentially lowering inflation. Nevertheless, this mix of increased expenses and decreased expenditures can lead to a pattern that hinders economic expansion, impacting individuals ranging from employees to entrepreneurs. Ultimately, although increasing interest rates may assist in managing inflation, they can also generate a cascading impact on different facets of the economy. Increasing interest rates may appear straightforward, but it is actually a nuanced balancing act that necessitates thoughtful evaluation. Central banks, such as the Federal Reserve in the US, utilize interest rates as a tool to manage inflation and maintain economic stability. Increasing interest rates makes borrowing more costly, leading to potential reductions in spending and investment. Yet, if rates are raised rapidly or excessively, it could result in an economic downturn. This was apparent in the early 1980s as the Federal Reserve hiked rates to a whopping 19% in order to tackle skyrocketing inflation. Although this action effectively managed inflation, it also led to noticeable economic difficulties, such as increased unemployment and a reduction in economic growth. On the other hand, inflation can sometimes have positive effects on the economy. A moderate amount of inflation can promote growth by motivating individuals to spend and invest instead of saving their money. When prices increase slowly, consumers are encouraged to buy earlier rather than waiting. Yet, if inflation remains at elevated rates over a prolonged time frame, it can lead to significant problems. This scenario frequently results in a cycle where increased prices prompt employees to ask for higher salaries, causing businesses to then increase their prices further. This process can result in a difficult situation for both customers and companies, causing an increase in the cost of basic goods and services and putting pressure on household finances. Therefore, it is essential for policymakers to carefully handle managing interest rates and inflation in order to sustain a strong economy. Central banks are essential in overseeing a nation's economy, with one key task being to regulate inflation. Inflation is the speed at which costs for products and services increase, potentially diminishing buying ability if it becomes too excessive. Central banks strive to establish transparent future inflation rate expectations to control inflation. If they are able to effectively convey their dedication to keeping prices steady, businesses and consumers might change their actions in response. This can prevent the necessity of extreme actions, such as a substantial increase in interest rates, that may hinder economic expansion. However, the correlation between interest rates and inflation is intricate. When central banks increase interest rates, the cost of borrowing goes up. This could result in decreased consumption and investment, ultimately causing a downturn in the economy. It's crucial to understand that the impacts of these alterations do not occur instantly. They may require time to become apparent, sometimes taking up to 2 years. This postponement creates difficulties for central banks in determining the appropriate timing and size of their actions. They need to carefully assess the present economic state and predict forthcoming developments, all while maintaining a balance between stability and the danger of reacting excessively. The central bank's role is a challenging one. There is always the chance of unforeseen outcomes, like a sudden economic decline or market crash, even when making informed choices. Central banks need to handle these risks while also working to uphold public trust in their capacity to control inflation. Clear communication is crucial because it helps build trust in the central bank's responsible actions, reducing the risk of panic-induced decisions that might cause economic instability. In the end, increasing interest rates is one of the limited strategies central banks can use to effectively address inflation. Although essential for securing long-term economic well-being, careful evaluation and a thorough comprehension of economic dynamics are needed. Central banks can contribute to a stable economic environment by effectively communicating their strategies and effectively managing expectations, which in turn enables sustainable growth and controlled inflation. So, yes, raising interest rates can be painful, but central banks believe it's necessary to keep inflation low and steady in the long run. Thanks for watching, and don't forget to subscribe to stay updated on all things finance.